Hello, let's walk through some questions. I've asked you to solve some of the questions for yourself. If you have already tried that, then this video is just to help you mark yourself, check what you have done. If you've not done that, I'm still giving you the chance to do it. So I'm not going to solve the questions for you completely. I'll walk you through it and tell you what you should be doing because there is something I want you to understand. You need to practice until you get some of the basic concept very clearly. Because as we go on, we'll be adding more, and you don't want to be overwhelmed. And so you need to understand every stage very well before we add the next stage. So, question 9. On 1st June 2010, Premier acquired 80% of the 5 million shares. Immediately, you know they acquired 4 million shares. 4 million. So the number of shares acquired 4 million, and therefore 1 million belongs to non-controlling interest. The consideration consists of two elements. A share exchange. So you have share for share exchange. The first one is 3 shares in Premier for every 5. So it is 3 for 5. And we'll issue this at the share price of Premier, which will be at 5 cedis. So, and then the second one is the 106% loan notes for every 500 shares. And so again, you will take the shares acquired and divide by 500. Okay, so always you need to have this understanding. So just straight away, your purchase consideration will be made up of 1, 4 million shares acquired divided by 5. The 5 that we will take from the subsidiary Sanford and multiply by 3 that will be issued by Premier. Then that will give you the number of shares issued. Think about it. It will give you the number of shares issued. 4 million divided by 5 times 3 gives you the number of shares. And then you multiply by the price and you get the value of the shares. And then for the second element, 4 million divided by 500. 4 million divided by 500 shares will give you uh, the number of loan notes and you multiply by 100. So you have 4 million by 500 shares. 4 million shares acquired by 500 times 100, and it gives you the value of the loan note. And when you put the two together, you will get your purchase consideration. Your NCI is measured at full method. Net asset at the date of acquisition is 7 million. And you can see that you were told NCI is measured at full method. That's all you are told. You have to know that 20% is for NCI and 20% of 5 million is 1 million shares. Those shares will be valued at 3.5, the price of Sanford shares, and that will give you your NCI for this question. Let's look at it. So there we have it. Number of shares acquired. 80% of 5 million will give you 4 million shares for Premier. Then for the share for share exchange, which is 3 for 5, you take the 4 million divided by 5 and multiply by 3 and multiply by the share price, and that gives you 12 million. And then your second element of the purchase consideration is 6% loan notes at 100 Ghana. So every 500 of the shares for 100 Ghana loan, 6% loan notes. So you divide again the 4 million shares acquired by the 500, and you multiply by 100, and that gives you 800,000. So your liability will be 800,000. You have equity shares of 12 million and liability of 800,000. So your total purchase consideration is now 12,800,000. Now you have your purchase consideration using your NCI, which is 20% of 5 million times 3.5. You can now calculate the goodwill. So now go ahead, calculate the goodwill in this question. For question 10, Parentis acquired 600 million equity shares of the total 800 million 25 Pessoa equity shares in Offspring on 1st April 2006. The purchase consideration was made up of a share exchange of one share in Parentis for two shares in Offspring. So that's what you describe as 1 1 for 2. And then the issue of 10%, 80 Ghana Cedi, 10% loan notes for every 400 shares acquired. So again, 600 million shares acquired. You will divide that by 400 and multiply by 80. For the first one, you divide the 600 million shares acquired by 2, multiply by 1, so it will be the same. And then you use it for that. Okay. Then a deferred cash payment of 11 pesos per share acquired payable on 1st April. So look at the date of acquisition, 1st April, and the date they will make the payment is 1st April now, 2007. The acquisition date is 2006. The payment date is 2007. That makes it 1 year. So you will have to calculate the present value of the cash payment, which will be again 600 million times 11 pesos times 11 pesos, and then you discount it at 10%. The cost of capital is 10%. You discount that at 10% for 1 year, and that will be your deferred consideration. Deferred consideration. Remember, the value of Prentice share at the date of acquisition is 75 pesos, and so that is what you will use in determining the value of the share for share exchange. Let's see how that will also look. So here, the number of shares acquired, 600 million. 600 million. The share for share exchange is 1 for 2. So take the 600 million divided by the 2, multiply by 1, and multiply by the price of the Prentice share, which is 0.75. 0.75. Make sure you take the correct share price, and that gives you 225. And then the 10% loan notes, you take the 600 million divided by 400 times 80 Ghana Cedi. That's the loan they issued, and that will give you 120 million. All these figures, please take your calculator and punch, and make sure you are getting the same figures. Practice how to get your figures. Your deferred consideration is 600 million times 0.11. That's what they will pay after 1 year. However, because they will pay this in the future, deferred consideration, you have to fair value this by discounting it to present value. And present value of this amount at 10% for 1 year, you have a discount factor of 0.909, and that's what is giving us 60 million. Your total purchase consideration is therefore 405. It is 225, 120, and 60. That's giving you 405. Again, I have helped you to understand the purchase consideration. That's what the emphasis is on. Now, look for how NCI is measured, add it to it, and then look for your total net asset acquired, deduct it, and that then will be your goodwill, right? So just for emphasis, the retained earning of offspring is 120, and the NCI is measured at full method, and it is the fair value of the NCI is 125 million. So that's fair value of the NCI. Now you need to determine the net asset, your share capital, and the retained earning at acquisition. We've gone through an example. Go through and calculate the goodwill. You cannot calculate goodwill if you do not determine the purchase consideration. So that is what I'm emphasizing on for now. Go ahead, practice. Thank you.